Have you ever looked back at a financial decision you made and just cringed? You know, that moment where you think, what on earth was I thinking? Well, you're not alone. We all like to believe we're super logical with our money, but the truth is, our brains are hardwired with these hidden glitches that can make us do some really strange things. So let's dive in and uncover the hidden psychology behind our money moves. So let me ask you straight up, are you a rational investor? I mean, do you really weigh all the data, calculate every probability, and act on pure, cold logic every single time? For decades, all the classic economic models just assumed we all do. But what if that entire assumption is just wrong? Yeah, for the longest time, the entire world of finance was pretty much built on this myth of the perfectly rational person. But then a totally revolutionary field came along and decided to ask a different question. How do real people with all our emotions, our quirks, and our weird habits actually handle their money? And this really lays it out perfectly. On one side, you've got traditional finance. It sees us all as these flawless little economic robots or agents operating in perfectly efficient markets. But on the other side, you've got behavioral finance, and it throws psychology right into the mix. It admits that, yeah, we make mistakes, we have biases, and, we're human. I love this way of looking at it. Your brain isn't some perfect spreadsheet. Not at all. It's an incredibly powerful machine that's been programmed by thousands of years of evolution. And the thing is, sometimes that ancient survival programming isn't the best fit for the modern world of stock markets and 401ks. So let's just call these programming quirks what they are: financial glitches. These are the cognitive biases that, get this, systematically and predictably cause us to make decisions that aren't always in our own best interest. Okay, first up is the undisputed heavyweight champion of all financial biases, loss aversion. The idea is so simple, but it is incredibly powerful. Basically, the pain you feel from losing $100 is way, way more intense than the pleasure you get from finding $100. In fact, they've actually put a number on it. Studies show that a loss hurts, on average, up to 2.5 times more than an equal gain feels good. Just let that sink in for a second. That massive emotional imbalance completely warps our decision-making. It can make us too scared to take good risks, or, weirdly enough, it can make us gamble recklessly just to avoid locking in a loss. And this is where it hits home for so many of us. It's that feeling of get-evenitis. You know a stock is a dog, but selling it makes that loss real, and that hurts. So you hang on, hoping and praying for a comeback, all to avoid that powerful sting of defeat. That right there is loss aversion in the wild. Let's be honest, our brains are lazy. They have to be. To save energy, they create these little mental shortcuts. They're called heuristics, to make quick judgments. And most of the time, they're super useful. But when it comes to investing, they can be an absolute minefield. All right, let's try a classic little experiment. I want you to picture someone named Linda. Okay? She's 30, she's single, she's outspoken, and very smart. Back in college, she was really passionate about social justice issues. You got a picture of her in your mind? Good. Okay, now for the big question. Which of these two things is more probable? A, Linda is a bank teller, or B, Linda is a bank teller and an activist in feminist movements. Just go with your gut. Which one feels more likely? If you picked B, don't worry, almost everyone does. And you've just been gently tricked by your own brain. Here's why. It is statistically impossible for two things together to be more likely than just one of those things on its own. The group of all bank tellers has to be bigger than the smaller group of bank tellers who are also activists. We pick B because it creates a better story, a story that feels more representative of Linda. Our brains prefer a good story over good stats every time. Now here's where it gets really interesting. These glitches aren't just a you problem. When you have millions and millions of investors all making decisions with the same mental shortcuts and biases, well, the entire market can start to act in some very strange, but also very predictable ways. So, what traditional economists might call weird anomalies, behavioral finance folks see as totally predictable regularities. I mean, take the weekend effect. For years, markets have tended to perform worse on Mondays. Why? Well, one leading theory is we're all just in a bad mood. It's a global case of the Mondays. Or the January effect, right? A little bit of tax strategy mixed with some New Year optimism often gives small stocks a nice little bump. These aren't just random flukes. They are clear patterns driven by our shared human psychology. And that is the huge aha moment right here. The market isn't some cold, logical, abstract machine.
It's the sum total of millions of human decisions, complete with all the fears, the greed, the biases, and the mental shortcuts we've been talking about. In a way, it's just a giant reflection of our collective mind. Okay, so our brains are flawed. We're all wired with these biases that can cost us real money. The million-dollar question is, what in the world can we do about it? How do we actually fight our own hardwired instincts? Well, there's a process for this, and it's called debiasing. Step 1 is the most important: awareness. Just knowing that these glitches exist is half the battle. Seriously. Step 2, get an outside view. A good advisor or even just a trusted friend can call you out on your emotional blind spots. And third, you have to reframe your decisions. Think about that losing stock you're holding. The money you paid for it, it's gone. It's a sunk cost. The only question that matters today is this: would you buy that stock right now at its current price? If the answer is no, you probably know what you need to do. This is such a brilliant way to think about it. A good advisor isn't just a number cruncher. They're more like a financial physician. They need to understand your personal history, your personality, your specific psychological makeup to prescribe the right financial strategy, and more importantly, to help you stick with it when the markets get crazy and your emotions start screaming. So there you have it. The perfectly rational investor is a myth. Our minds are full of glitches that can seriously impact our financial health. But knowing this isn't just interesting trivia, it's a powerful tool. So the question is no longer if you have these biases. We all do. The real question is, now that you know they're there,